Greetings. For a rapidly evolving news story like this Silicon Valley Bank story, I'm not going to do a fully curated video that has all the stock footage and high quality editing and so forth. It's just going to be some unorganized thoughts in episodic form. So this is going to be the first episode of that, which is the banking aspect itself of the Silicon Valley Bank implosion. Silicon Valley Bank has imploded because it could not cover its deposit integrity. Now, if you're not from the tech industry or from Silicon Valley, you may have never heard of Silicon Valley Bank before. Prior to collapsing, it had a valuation of only $6 billion, and the extent of its deposits was very little compared to the major banks such as Citigroup, Wells Fargo, Bank of America, and so forth. This is the stock price of SVB Financial Group, which is the same thing as Silicon Valley Bank. And during COVID, because of the high amount of money printing, but specifically the money printing in the form of buying treasuries and mortgage-backed securities, all banks rose a lot in price. But Silicon Valley Bank benefited from something else, which is that a lot of tech companies were getting venture financing to a much greater extent than they may have gotten before, and those tech companies kept their corporate bank account at Silicon Valley Bank. Many VCs, venture capitalists, actually required that their portfolio companies, meaning the ones they invested in, kept their money in Silicon Valley Bank because they wanted the analytics from Silicon Valley Bank in terms of things like how much money the average venture-backed company has, how many months of burn rate, and analytics like that to give them some indications about the financial health of these private tech companies that VCs invest in. Because the amount of money printing that was done went into tech companies, Silicon Valley Bank's deposits rose a lot. And because their deposits on hand were a lot, they invested in treasuries. But now as the Federal Reserve has stopped buying treasuries to lower their yield and has started selling treasuries, which increases their yield, Silicon Valley Bank saw the price of the treasuries they had go down. And unfortunately, they did not have the money to keep everything solvent. Now, the strange thing is that this was very predictable because the Federal Reserve said how long they would be printing for and that they would stop printing. And all those crash watch videos that I do focus on how much money printing is going on, not just in the US, but in the world's level. World money printing has resumed, so Silicon Valley Bank probably only needed to survive for a short while longer to get out of the woods, but they could not. And their share price went down a lot because this bank has failed and is now going to be taken over by the FDIC. Now, the other problem is, since all of these tech startups that were venture-backed were in many cases required to bank at Silicon Valley Bank, that means this entire ecosystem was dependent on one bank. So while it has a very small impact on the broader U.S. economy or world economy, it has a very high impact on technology private companies. This is not bad for the big tech companies because they don't bank at Silicon Valley Bank. Apple, Google, Microsoft, Amazon, and so forth. It's actually good for them because a lot of these startups that might have disrupted the businesses of these big tech companies have had a setback and will have to reform. Different startups may have to form because some will have to close their doors, but the same team will resume their work again. And as VCs get more money, then they will reinvest in new companies that resume the same work. But the interruption is favorable for the big tech companies. Now, is this the tip of the iceberg as people are talking about? I don't think that is necessarily true. If anything, a small bank failure like this is a warning shot that gives existing banks some time to get their act in order. If other banks begin to fail, it will not be because of tech startup money or things like that. It will be because of mortgage-backed securities and mortgages like happened in 2008. That is the much larger, much more wide-scale pool of money. The other thing that is probably going to be revealed about Silicon Valley Bank's failures is that it had something to do with cryptocurrency, probably. Not even in any direct sense necessarily, but cryptocurrency is going to be one of the contributing factors in the implosion of this bank. Not the primary one, but one of the contributing factors. Now remember, before the Federal Reserve's big start-stop money printing, things were going just fine. Things were stable, it was a bank, it functioned fine. By creating this bulge, this bank was in a situation where it could not survive a drawdown, even though it was back down to the pre-COVID levels. And that is why it also went under. The same thing is going to happen to home prices and mortgages, of course. Now, when a media story like this occurs, every possible political faction sees what they want to see in the story. It is a Rorschach test of sorts because people are going to be predisposed to see what they want to see. For example, If you recall, in 2008, it first began with some institutions, Bear Stearns, Lehman, and others. The problem with the Federal Reserve is that they're the bluntest of blunt instruments. FDIC insurance, the amount of insurance that protects your deposits of $250,000, is adequate for most consumers. Most consumers don't even have that much, or if they do, they don't keep it in their checking account at the bank. For businesses, that's not enough. Silicon Valley Bank was heavy in business accounts. I don't even think it had consumer accounts. And because it was heavy in business accounts, 97.5% of those accounts were actually greater than $250,000. And as a result, a lot of startups that thought they had 6 to 9 months of cash in the bank have now learned that their bank account has gone under and they may have only 2 to 4 weeks before they can fail to meet payroll. This can cause a domino effect across Silicon Valley and the tech industry, and a lot of people are going to say, well, they deserve it. They got their comeuppance, but they didn't deserve that their bank should fail, and that a startup working hard to innovate on something suddenly finds that the funding they thought they had, they don't have. And so that's why there's a large negative multiplier effect over this. So the Federal Reserve, which doesn't understand technology and certainly doesn't understand startups, their understanding of economics is very, very theoretical, and therefore they may say, oh, a small bank fails, that doesn't matter. They don't have a concept of, well, many of these companies are going to shut down and there will be layoffs of all these people, and companies that were doing very well until yesterday will actually have to shut down. And all those same people will get other jobs and more companies will form when the dust settles, but why even have this type of speed bump? The Federal Reserve is the bluntest of blunt instruments in that they only react to things a year to 18 months after the fact, and they always overshoot on both directions. That's why these PhD economists, being so theoretical, are about as far from being able to understand the startup economy as you could possibly imagine. To them, it's just a video game and things they read about in the news, and no concept of where the multiplier effects are, where human suffering occurs, where confidence goes away, and how there's a tremendous cost to being months and years behind the curve. Remember, in 2007, 2008, the Federal Reserve was about 18 months behind the curve before they started to do something. And then when they did something, they did too much and too late, as is always the case. So those were a bunch of tangential topics around the Silicon Valley Bank situation. More to follow, and thanks for watching.